Great. So I think we have quite a few participants here. Okay, so let's start. Dr. Gangopadhyay, you're there, you're ready?
Yeah, I'm ready.
Okay, excellent. So very, very warm welcome from Calcutta Business School once again for yet another exciting and enriching webinar. And a very special welcome to our speaker, Professor Dr. Parthu Gangopadhyay today. Then we also have our Secretary General, Mrs. Bratuti Bhattacharya. Then we have also our senior advisor for the entire group, Mr. Saurav Ghosh. Of course, we have our principal, sir, Professor Dr. Don, all the faculties of CBS, students, ladies and gentlemen, a very warm welcome to you for yet another webinar from Calcutta Business School. You know that we've been doing this for quite some time, and our webinars are extremely interesting, enriching experiences for all of us. Before we start, let me take you through the Sikshatan Foundation, which is the apex body under which the Calcutta Business School comes in. Sikshatan Foundation is the apex body with the following educational institutions, namely the Marwari Balika Vidyalaya, which was established in 1920, Sri Sikshatan School, which was established in 1954, followed by the Sri Sikshatan College in 1955, and Calcutta Business School, the last but not the least, in 2008. While these were the products of collective will and efforts of the trustees, the society has also started a residential management institution from July 2008, as I was just telling you, which was styled as the Calcutta Business School under the stewardship of Mr. S.K. Birla, who is also the president of the Society Sikshatan Foundation. Incidentally, Sikshatan Foundation was established in 1920, as I said earlier, so we have completed our centenary year last year. We are a 100-year-old foundation. We are very proud about that, to carry on this legacy for about 100 years, a century. There are also eminent members very closely associated as the trustees. Our Lady Secretary General of the foundation is Mrs. Bratuti Bhattacharya, and Mr. Saurav Ghosh is the senior advisor of the group. Calcutta Business School is one of the top AICTE Government of India approved autonomous management institutes in the Eastern region. It also ranked number 2. It provides a 2-year full-time postgraduate diploma in management and development programs, which are called MDP, at a green campus, in Vishnupur, which is near Joka and which is on the way to the Diamond Harbor. Apart from academic excellence, the educational institutions have excellent domains of co-curricular activities. Calcutta Business School has international exchange programs from time to time. This business school has regular activities like seminars, workshops of different areas apart from academics. The business school also organizes excellent placements for its students. Our placement record is almost about 100%. The group has more than 10,000 students now and about 500 staff members. So this is all about Calcutta Business School, but we will just take you through a small little video on the CBS and the Calcutta Business School, after which I will be very happy to introduce our honorable speaker for today. Let's have the small video, please.
If excelling is your essence, then you are welcome to Calcutta Business School. Center of Excellence, centered on excellence.
It all started in the year 1920, when some eminent industrialists of Kolkata founded the Marwari Balika Vidyalaya. Later, in 1954, Sri Sikshatan School was founded, and in 1955, Sri Sikshatan College came into being with the objective of further propagating quality education to girls. All these institutions have continued to excel under the management of the Sikshatan Foundation.
It has been guided by industrialists like President Mr. S.K. Birla, Director Emeritus, Birla Brothers Private Limited, Mr. Siddharth Birla, Vice President, Mr. G.K. Khaitan, Trustee and President of Sikshatan College, Mr. R.S. Goenka, Trustee and MD of Imami Group, and many other reputed industrialists. The Secretary General of the Foundation is Mrs. Bratuti Bhattacharya.
Greetings. I would like to speak a few words about our institution, the Sikshatan Foundation. The year was 1920, when some of my forefathers thought that female education needed to be propagated much more actively than was the custom in those days. And we donated from our family 2 buildings in the heart of Bada Bazaar for the girl child to be educated there. That institution is still working. The latest addition to our bouquet of institutions has been the Calcutta Business School, which was started a few years ago on a 15-acre plot of land and not very far away from IIM Calcutta.
Calcutta Business School offers an AICTE approved, autonomous, 2-year full-time residential program on postgraduate diploma in management, majoring in subjects like finance, marketing, IT, operations and human resource. But it's the unique cluster of courses that sets it apart. Interactive and intuitive games like management game and stock market simulation game. It also puts heavy emphasis on data handling and business analytics and uses databases and software like CMIE Prowess, MetaStock, R, and SAP.
Kolkata is the city of joy. It is the cultural capital of India, a city which has its soulful embodiment of culture, love, mystery, respect, and enthusiasm. A city that upholds a perfect juxtaposition between the old world and the modern one. It has given us many Nobel laureates over the years. It has iconic institutes like the Calcutta University, the National Library, Presidency University, Vishwabharati, IIM Calcutta, and many such legendary institutes. Calcutta Business School's AICTE approved PGDM program is carrying forward this rich legacy of Kolkata.
Welcome back. That was a short video about Calcutta Business School. I would request all the audience members to kindly mute their mics so that we do not have any interruption. So now, before we get on to the webinar session, it is my pleasure once again to welcome our honorable speaker as well as introduce him. Our speaker for today is Dr. Professor Partho Gangopadhyay. Let me have a small introduction of his. He's a PGDM from IIM Ahmedabad. He worked for the Blue Star Limited and the Shipping Corporation during 1984-85. He completed his PhD Finance from the University of Iowa. Professor of Finance at the St. Cloud State University since 1992. His current research interest is insider trading. So today's topic, which is extremely relevant in today's world for this evening, is corporate insider trading in the US, views from the street and academic research. With this, I welcome Dr. Professor Partho Gangopadhyay. Please grace this session and advise our students, all our academic and everyone is here. We are eager to hear to you, sir. Thank you very much.
Great. Thank you, Mr. Mitra, for that introduction, and thank you all for coming today. And my PhD is from the University of Iowa, by the way. And so good morning to all of you in the US who may be watching, and I think some of my colleagues may be watching on Facebook. And good evening to all of you in India. I will try to make this interesting, okay? I'll try to make this interesting. So I've been given only about 45 minutes, for this presentation. So I'm going to get right down to business, okay? So let me first talk about my qualifications for this, and my current research interests are in corporate insider trading, and I have data for the US. I don't have data for India. So my research is concentrated on the US. And this has been my area of interest for the past 10 or 15 years, my research area. I work with my co-author from Johns Hopkins University, which is a major research university. My co-author's name is Dr. Ken Uke. He's a professor there. And they have all this data, which we do not have. And so I get all the data from him. The data is from the Securities and Exchange Commission, SEC. The Indian equivalent would be the SEBI. And Ken and I have published many papers in this area. I didn't count how many, but many. And we have two that have been accepted recently in the last couple of months. And I was planning to talk about those a little bit. That would be, the academic research part, but, I don't know if we will be able to get to that. So we'll see. So this is my area of research. Also, I have been investing in the US financial markets for the last 29 years since I got this job and I had some money to invest. And in all that time, I have a portfolio of individual stocks and I follow the markets very carefully, very closely. And all that time, I have noticed some very, very suspicious, strange trades and price movements. I will give you some examples, and that will be views from the street part, and you will be the judge of that, okay? So interesting, suspicious, depending on your perspective, okay? I also have this book, this is written by two brothers, and there are a few dozen examples of very, very suspicious, interesting, whatever you want to call it, trades. Okay, this is called Follow the Smart Money. And this is written by two guys, two brothers who were former football players. And I think of them as the premium authority in this area, okay, because they do this for a living. So after they used to be football players, after their football career, American football career was over, they became options traders, okay? And I believe that a lot of insider trading goes on in spite of the legal prohibition in the US, and it's prohibited in most countries around the world, including in India. But I think a lot of that goes on, and it'll be impossible for the SEC to detect some of those. It's very easy to hide those. So there are several dozen examples of very, very curious trades. Two that caught my eye, one before the World Trade Center bombing, the terrorist attack in the United States. So there was heavy insider trading before that. Very suspicious trades. I don't know, I guess someone with inside information. So these two brothers, they're on TV all the time, and they started this business, and they noticed that a very large percentage of the trades, option trades that were executed by, the big boys, the traders working for Goldman Sachs and Morgan Stanley, those type of companies, a very large percentage of those trades were actually successful. Now, if you know anything about options, 80 to 90% of options will expire worthless. So if you're buying options at random, you will probably lose your money 80 to 90% of the time. So how is it possible? It was very curious that such a large percentage of the trades are successful. So what they did was they created this algorithm. It's called the Heatseeker, like a heat-seeking missile. And basically they scan through all of the US exchanges and maybe some foreign exchanges. And they identify, out of the millions of trades that take place, they identify 10 to 15 that seem very interesting, and they trade on those. Incidentally, the two brothers, Pete is one of the 100 top traders in the United States, and the two brothers sold this, algorithm to a large trading company some 10, 15 years ago for 750 million US dollars. That's in Indian, since, in India, people use crores, that would be 75 crore US dollars. In the US, people talk in terms of millions, and the two brothers split it up. But they still retain the right to use that. And so there are many examples, and I don't have time to give all of those, so maybe a couple of those. That will be the views from the street part, okay? So I think these guys make a living out of this, and so they are among the most premier authorities. They certainly know more than the government regulators, I believe. The regulators are not very sophisticated. The Wall Street traders are far more sophisticated, in my opinion. And they certainly know a lot more than academics, because academics live in ivory towers. They're not really managing money, So, they do academic research. So these guys, so I'll give some examples. So let's first understand what is insider trading. The law bans insider trading. So the law does not say that the CEO of Microsoft or Google, they cannot, buy or sell their own company stock. The law does not say that. The the CEO and founders and insiders of companies, large percentage of their wealth will be invested in their own company stock. And so for diversification, they routinely sell. Maybe at the end of the quarter on a certain day or a certain week, they're going to have on a predetermined schedule or schedule for the Indian audience. So they will sell the shares for diversification, and that's not illegal, right? They have the right to buy or sell their company shares, just like anyone else does. The law says that if you have any inside information, non-public information, whether you work for the company or not, you are not allowed to profit from it, okay? If you get caught, there will be serious consequences. You can go to prison, there will be monetary penalties, etc. Okay, so of course, passing a law is easy, but catching the criminals, and they are white-collar criminals, they're breaking the law, they're white-collar criminals. This is considered corporate fraud, insider trading, okay? This is very bad for society. People will lose their confidence. Investors will lose their confidence in the financial markets. And long term, that would be very bad for companies because they will not be able to raise capital when they need to expand, okay? So the law prohibits this. However, catching the culprits is a totally different issue, because the SEC gets these reports. Corporate insiders are required under US law to report their trades within 2 days to the SEC, but they get millions of reports in a given year, okay? Thousands and thousands daily, stocks, options, bonds, other derivatives, restricted stock. And how do you detect which ones are, maybe violating the law? And then then there's the question of prosecuting them in a court of law. It's easy in some cases. There was this famous case, which you may have heard of, a billionaire hedge fund manager, Raj Rajaratnam. He's from Sri Lanka, but he was a billionaire, founder of Galleon hedge fund. And he got really arrogant. He was guilty of insider trading, but he was bragging. And the SEC typically depends on whistleblowers, someone who comes forward with a tip. And if they have some evidence like an email or, a recorded phone message, so he was easy to catch. But in most cases, it's not easy to catch. So from the insider's perspective, and I've read this in many articles, but this may be an academic view, that the risks of getting caught are low, but the rewards are could be extremely high, lucrative. Okay, so the risk reward equation actually favors insider trading, and there are some cases that are gray areas, so we'll talk about that. So any of you, students of Calcutta Business School sitting in India, if you have inside information on an American company and you trade on it, you are violating American law, and you may be violating Indian law also, okay? So anyone who has inside information. Now, the law was not defined like this earlier. So in the 1980s and before, the rules were much more relaxed. There was this really interesting case, and I'm trying to make this interesting for you, okay? Maybe this is a dull, boring topic to many, not to me, but I'm trying to make this interesting. There was this interesting case of a printer in the 1980s by the name of Vincent Chiarella. So he became very, very wealthy. And someone reported to the SEC, maybe there's some wrongdoing going on. Who, I don't know, maybe a jealous neighbor, maybe a jealous cousin, I don't know who, maybe whoever. So the SEC did an investigation and then found out that Mr. Chiarella got a lot of documents for printing, okay? And he was a very clever man. He figured out that some of these documents had to do with mergers and acquisitions. So it's like getting tomorrow's news today, all right? So, and he figured out that in an acquisition, a buyer will typically pay a premium price for the target. So let's say the target is company B and their shares are selling at $50 today. And the buyer, maybe company A, offers 75, they're negotiating 75. So as soon as the information is publicly released, the stock price of B will jump to over 70, approaching 75. It won't get to 75 because there will be some uncertainty, with regulatory approval, shareholder approval, etc. But so he started buying, if he could buy at 50 and sell at 72 within a week or a couple of weeks, and then he could repeat that over time. Okay, so that's how he got rich. Now the courts decided he did not really work for any of these companies, so he was not an insider. So Congress tightened up the rules substantially, and in the 1980s, and they passed the Insider Trading Sanctions Act in 1988. And today, anyone who has inside information will be guilty if they trade on that and profit from it. Okay, so there is also a large gray area where it's not clear whether they're violating the law. Okay, and let me give you an example. Okay, and you be the judge of that. Okay, you tell me, okay, whether they're violating the law or not. So there's a business development company called Prospect Capital in the United States. So the BDCs are called private equity in India, but in the US, private equity means something different. So these companies, the Prospect Capital and other business BDCs, they provide financing to companies that cannot get a bank loan, typically small companies and mid-size in the middle market, okay? And so these companies cannot get a bank loan because to get a bank loan, you need collateral, and they don't have collateral. So the US government wanted to encourage development of this sector because these middle market companies and small companies, they employ millions of people in the US. So they give the BDC some special tax treatment. They don't have to pay tax as long as they distribute 90% or more of their profits as dividends to their shareholders, right? So they typically pay very high dividend. Now, in 2008, 2009, I'm trying to kind of rush through this because of the time limitation. 2008, 2009, you probably remember that there was a major financial crisis in the US, which spread to many European countries and some Asian countries, okay? And so the stock markets went down over 50%. So Prospect Capital went down, with the market from between 9 and 10 to between 3 and 4. Okay, so I read a report at that time that the CEO, this guy, he bought $100 million, that's 10 crore US dollars, worth of Prospect Capital shares with his own personal money. Okay, so, and then what happened? And I saw reports that other executives also, bought shares of Prospect Capital. I did not. Even though I have been following this company for over 15 years, I did not, because I was thinking there was a major recession. It was called the Great Recession, the biggest recession since the 1930s Great Depression. And many of the companies that Prospect Capital lend money to, they would probably go bankrupt. And so Prospect Capital would have to write off all those loans, and then they might go bankrupt themselves. But the CEO put that much of his own money into this business. And so what happened? Well, the markets recovered, the economy recovered, and Prospect Capital went back to over 9. So he bought below 4, and it was over 9. And if the dividend yield at 9 is $7, these companies pay very high dividend. At 450, the dividend would be 14%. If the dividend yield was 7% at $9, if the dividend yield was 7% at $9, when the stock price goes down to 450, it will be 14%, right? So on top of doubling the money, he probably earns 15, 16% dividend. So was he violating the law? You tell me. I can see arguments on both sides. Well, one argument could go as follows, that, well, he did have in private knowledge that Prospect Capital was going to come out fine on the other side, okay? Because he had knowledge of the loans he made, and he had knowledge of what kind of hedges they had in place, okay? So those are all private knowledge. As an outsider, I did not have those knowledge. So I did not buy the stock. So one can argue that he was using private knowledge, if not information. That violates the spirit of the law, if not the letter. However, the SEC won't even bother with a case like this, okay? Because they would have no chance of winning in a court of law, okay? Because all the CEO has to say is, I was being a contrarian trader. Now remember this term, okay? Because this is a major source of profit for insiders. Insiders are known to be contrarian traders. There is a large literature on that. So what's contrarian trading? Do opposite of what others are doing, okay? The world's greatest contrarian trader is Warren Buffett. You may have heard of him. And he's probably the greatest investor ever in the history of investing. And Warren Buffett's famous quote is, be greedy when everyone else is fearful, and be fearful when everyone else is greedy. So the CEO could say, I was just being a contrarian. And it's well known that insiders are contrarian. Prospect Capital went down from between 9 and 10, over 9 to under 4. And, in my opinion, that was a gross overreaction. So, how do you disprove that in a court of law beyond a reasonable degree of doubt? Okay. So the SEC wouldn't even bother with that. So was he violating? This is a gray area. Was he violating the law? Maybe, maybe not. Okay. Incidentally, last year in 2020, when COVID hit the US, the stock market went down 34% in less than a month. Prospect Capital again dropped from over 9 to under 4. And the CEO again bought $100 million plus of the shares. Now, I remembered his trading history last time, and I didn't buy in 2008, but this time I followed him into the trade, and the stock price doubled. So, I'm very happy that it did, but was he violating the trade? This is one of those gray areas. Okay, so let's go over some examples. Okay, the SEC requires that corporate insiders report their trades within 2 days after the trade. Now, what about someone who is an insider but who does not work for the company? There is no reporting requirement. So that's one major drawback, okay? Suppose the CEO does not trade himself or herself, but passes on that information to his or her, brother-in-law, okay? And the brother-in-law trades on that. The brother-in-law, if he does not work for the company, he's not required to report to the SEC. So how is the SEC going to catch him? Okay, the SEC depends almost exclusively in such cases on whistleblowers. Okay, someone who will have to come forward and tip them. And so the Congress passed a law after the financial crisis, which called in 2010. It's called the Dodd-Frank Wall Street Reform and Enforcement Act. Yeah, and so my research with Ken, the 2 papers that got published, accepted this year, not published yet. So we were looking at what happened to insider trading profits before versus after. But I'll talk about that later if there's time. Maybe there won't be any time. So let me give you a couple of examples. The SEC has a very hard time catching these guys, especially in options trade. In the options world, it would be impossible. So let's say someone buys a large number of call options. Now, even if you don't know what an option is, you will be able to follow the story. So if you're buying a call option, you are betting that the stock price will go up within it has to happen within a certain period of time because options have expiration date, but these are highly leveraged. So if the stock price goes up 10%, the option will probably go up 60, 70%. If the stock doubles, the option may go up like 6 or 7 times, okay? So these are highly leveraged and they attract a lot of speculators. Speculation is not illegal. The options are created for hedging, okay, primarily. So it attracts a lot of hedgers like big banks and other money managers and private companies. However, there's probably a lot of insider trading that goes on in the options world also. And the SEC will not be able to catch most of them for the following reason. Let's say there's a large purchase of call options on a particular stock today. Well, maybe the person or trader who's buying the options, maybe that person sold the same option, in several batches over the last year, maybe, over a period of time. Or maybe the trader did not even sell the same option, but sold the call option of a related company. Or maybe they are doing some strategies with puts and calls. There are many different strategies that are possible. To catch an insider trader in the options world, the SEC will have to dig through thousands and thousands of trades to catch one miscreant, okay? And because, these option traders, people who do it for a living, they're not buying 1 or 2 options. They're doing thousands of trades every year. The SEC will literally have to go through all of those trades to see if they can match it. So basically, these Nigerian brothers, they created this Heatseeker algorithm, and they go through all of these trades, millions of options that are traded every month, every year, and they have these filters and they find out 15, 20, as I mentioned. However, they're not required to, this is proprietary, share that algorithm with the SEC. There's no such requirement. The government cannot just say, that we need that, tell us how you find these guys. So anyway, so it's next to impossible to detect insider trades in options. And I do believe a lot of that goes on, especially in the options world, highly leveraged. So if you're right, let me give you a couple of examples of actual trades, very curious from my investing experience. So there was a company called Todd Shipyards about 8 or 10 years ago. And one morning I read a report, that the Todd Shipyards on no news, the share price had gone up by about 80% over the previous month. Okay, no news. And I looked for news and there was nothing. And so this was a Wednesday or a Thursday morning. So, that's not my style of investing. I stay with very stable, good companies like Apple, Costco. I've been in those for over a dozen years, so that's my, I invest differently, but I'm not above gambling a little bit. So I do have a little bit of money for situations like that. So I bought some Todd Shipyard shares. Okay. If I lose that, that's fine. Okay. So it became clear why, Todd Shipyards had gone up 80% the next Monday. Well, it turns out that someone was buying, Todd Shipyard, some other company. So they've been bought and they're no longer there as an independent company. And after the news became public, Todd Shipyards went up another 20%. So I got the last 20%. But most of the gain, 80%, took place before the news was announced in the prior 2, 3, 4 weeks. So was that insider trading or not? I mean, you tell me, was anyone caught? I don't know. As soon as the merger news is announced and the price reacts, you just sell and walk away. And I didn't keep up with the story. Let me give you another example. There's a company by the name of Pharma. Okay, the ticker symbol KPTI, if anyone wants to look them up. This is a pharma biotechnology company. Is there a question?
Yes, I think there is a question from Meghna. Meghna, can I request you to just hold on to you for a while?
Yeah.
Let Sir complete this and we will take all the questions after this.
Yeah, that would be best. Yeah,
Yeah.
thank you. Thank you. That would be best. Yeah, I was going to say that at the beginning, but I forgot. Yeah. Okay, so Pharma is an American biotechnology. I'm not exactly sure. So that tells you how little I know about them. So, I read a report, and this was again towards the end of the week, that, they had a drug for a rare form of bone cancer in front of the FDA, Food and Drug Administration, and FDA was looking at it, but the FDA will probably reject most of those trades. This company was trading for between $5 and $6 at the time. This is June, July 2019, a couple of years ago. And someone bought I read a report, someone bought a huge number of call options, betting that within 10 days, the stock price would go over 10. Okay. So that's a very unlikely bet, isn't it? I mean, it's selling between 5 and 6, and someone's betting within 10 days it'll go over 10. Well, the following week, the FDA approved it. This is an actual case. I'm familiar with it. Okay. The FDA approved the drug. Okay. And Todd Shipyards went to over 10. Okay. Now, you tell me who was trading. Was this insider trade or not? I mean, you tell me. The FDA people, scientists in FDA, they're not trading. Okay, it would be too easy to catch them, but probably someone knows something, and so these guys, these Nigerian brothers, pretty faces. So they have. Here's a quote from their book: "You don't need to know what is going on. You just need to follow someone who does." So they do this for a living. So here's a couple of examples from their book. Okay, these are stunning. Okay, so there was a company, investment bank, very large investment bank called Bear Stearns. I'm looking at the clock here, trying to time myself here. Bear Stearns, I don't know if you've heard of this. This was one of the largest investment banks in the United States, and they got into serious financial trouble in 2008. Okay, so there was a very unusual, very low probability of success type trade. Okay, they talk about this in this book, And this is a stunning story, probably the most amazing one. That's why I picked this, that I've read about. March 11, 2008. Okay, so Bear Stearns, their stock was selling for 65, March 11, 2008. Stock was selling for 65. They had $18 billion of cash on their balance sheet. And the Federal Reserve that day had announced a lending facility for primary dealers like Bear Stearns and Morgan Stanley and Merrill Lynch. Okay, and here comes a big trade. So someone bought 55,000 put options. Okay, a put will give the buyer of the put the right to sell 100 shares. So 55,000 put option would give the buyer to sell 5.5 million shares of Bear Stearns. Get this, at $30 within 10 days. So this guy, this person, whoever this person was, bought the right to sell 5.5 million shares of Bear Stearns for $30 with an expiration of 10 days. The stock was selling for 65. Bear Stearns was looking good. Very few people except insiders knew what was to come. Okay, so at that time they were looking really good. Now, a very unlikely option like that, deep out of the money, very unlikely to succeed, would be very cheap. So this person spent only 1.7 million US dollars to buy 55,000 puts. So what happened? So the following week, within a week, the information was leaked out, came out that Bear Stearns was in financial trouble, and the stock went to $5. So it dropped from $65 to $5. And the $1.7 million that this trader invested in the put options, those turned to 270 million US dollars. Okay, that's a 16,000% return in 1 week. Was that insider trading? It had to be, right? Right? I mean, who in their right mind would buy a put option that would give them the right to sell at $30, when the stock is within 10 days, when the stock is selling for 65, and there's nothing, no bad news. At that time, there was nothing going on with Bear Stearns. But the following week, information came to light, and the Fed arranged a hasty merger. I forget who bought Bear Stearns, maybe JP Morgan, one of the big banks, or Wells Fargo, I don't know, probably JP Morgan. They're still there as a subsidiary of JP Morgan. And the last one, okay, so my time is running out, last one from this book again. So they talk about a very unusual trade right before the terrorist attack of 9/11. Okay? 9/11, 2001, the World Trade Center was toppled in the United States. You probably know about that. A bunch of terrorists. This led to the Afghanistan war and the Iraq invasion. All right. And so in weeks before the attack, so there was very unusual large volume put option trades on, guess what? American Airlines and United Airlines. Now, planes from American and United were used by the terrorists to attack ram into the World Trade Center and the Pentagon, right? And so these two airlines, not other airlines, not Delta, not Southwest, but American and United. So someone knew. So someone was betting heavily that these airline stocks would go down, okay, in the near future, all right? So these brothers, they detected that trade and they reported that to the FBI. The FBI investigated that and they traced the trades back to a trading account based in Hamburg, Germany. Now it's now well known that these terrorists were being trained in Hamburg, Germany. Okay, so they did report to the FBI, and there was an FBI investigation. So there are dozens of examples like this, and my time's running out, so I don't know how much time I will be given. So that's all.
Professor, you have some more time. There is no problem.
Okay.
Please carry on.
Okay, good. That's what I like to hear.
Yeah.
That's what I like to hear. So those are some examples, and there are dozens more in this book. So let's get to the academic research part. So I have read the literature, much of the literature, because I've been working in this area. And the literature goes back to the 1960s and 70s. And there are still papers being published in 2010. There were a couple of papers in 2010, 2018, 19. that show consistently that corporate insider trading generates huge amounts of profits for the traders. Okay, so consistently since the 1960s, early literature, people like Jeffrey Jaffe and others, and then current literature consistently shows insider trading leads to huge profits, buying, especially buying. The insiders sell for a number of reasons. So insider sales are typically not profitable. They sell for diversification. Most of their money is tied up in their company stock. So they sell from time to time. However, just because they're profitable does not mean they're illegal, right? So the literature has identified at least two different sources of insider trading profits. One is something we talked about, contrarian trading. When everyone's selling, the market is crashing, it pays to buy, right? I mean, we should all be buying when the market crashes, but very few people have that kind of courage, right? But insiders have, maybe some knowledge of their companies, that their companies are not going to go bankrupt, So, insiders typically buy when everyone is selling. So that's contrarian trading. That has proven to be a very profitable long-term trading strategy, because you can trust the average guy to make the wrong trades, okay? They're going to come in after it's gone up, market's gone up, and they're going to sell after it's gone down. You should do the opposite. That's Warren Buffett's philosophy. So contrarian trading is based on publicly available information. Is that illegal? No, it is not, okay? So you have to separate contrarian trading from, possible use of private information. Now, in academic literature, academics have to be careful about the words they use, and so they cannot say this is indicative of insider trading. No, we don't have any proof of that. That remains to be proven. But we can say, maybe, potentially. So let me talk about my research briefly. Okay, so Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010 after the financial crisis of 2010. Okay, and so basically what happened after the Dodd-Frank Act was passed, the SEC, the CFTC, Commodity Futures Trading Commission, and other regulatory authorities, they stepped up enforcement action. Okay, and the SEC has a whistleblower program. The Dodd-Frank Act provides a lot of protection to whistleblowers. Typically, if you are an employee of a company and your CEO is guilty of insider trading, are you going to come forward? Most likely not. You're certainly going to lose your job, right? And nothing may happen to the CEO. I mean, it has to be proven in a court of law beyond a reasonable degree of doubt. So the Dodd-Frank Act provides extensive whistleblower protection. It's illegal now, for the company to go after the whistleblower. Okay, so if they have some sort of retribution, then that's itself is illegal now. And also the Dodd-Frank Act provides financial incentives for whistleblowers to come forward. As a matter of fact, if you go to the SEC's website, they say between 2011 and 2018, I forget most of the statistics, but one number I remember, $300 million was awarded to whistleblowers between 2011 and 2018. This is on the SEC's website. 300 million, that's 30 crore US dollars. And so a whistleblower comes forward. If they have a successful prosecution, they have what they call recovery, that is getting money back from the insider. And from that, the whistleblower gets a portion. So this has been hugely successful. There is also a relatively large, but relatively new literature that says anytime the financial media or press focuses on a law, then there is that curtails insider trading because insiders become fearful, okay? And then the Dodd-Frank Act was covered extensively in the media in the years following after the passage of the act, and I remember some of the articles, I'm trying to remember, something to do with Rajat Gupta, prosecution of Rajat Gupta is testing Dodd-Frank, articles like that in the financial press, and stepped up SEC enforcement and CFTC enforcement. So this literature says that, that instills fear among insiders, and so they curtail their strategic trading, at least for a while. Now, 10 years from now, maybe things will go back to normal, okay? So we wanted to see what happened to insider trading profits, after the Dodd-Frank Act, before versus after. So I have some, I didn't realize how much time I would have. So I have some, preliminary numbers here. These are from tables from a paper that has been accepted now with Ken Yuk. So let's take a look at this. Opportunistic insider purchases. So of the millions and millions of trades, the SEC has probably 15 million trades or more going back to 1986. And how do you detect, the few that look suspicious, all right? So there's a famous paper by Cohen, Malay and Pomersky that was published in Journal of Finance in 2012. And they found an easy way, of separating these information-rich trades. They call those opportunistic trades. So we use their methodology here to identify opportunistic insider trades. So before and after the Dodd-Frank Act. So here's some descriptive statistics, but these will only tell us so much because a lot of these profits may come from legal contrarian trades. So opportunistic insider purchases, we found that sales were contrarian trades, so they were profitable, but the stock prices kept going up after they sold. So we focus on purchases. So NPR, net purchase ratio, so this is basically an indicator. These are indicator variables for insider trading. What we do is for each stock, for each month in the sample, we calculate the number of shares that insiders bought and number of insider purchases minus number of shares that insiders sold, or minus the number of insider sales divided by total number of shares traded, or total number of trades, purchases and trades. So this is a ratio. So all you need to understand here, for brevity, NPR, SPR, share purchase ratio, net purchase ratio. So if all the trades in 1 month in IBM were insider purchases, NPR would be 1. If all of those were sales, NPR would be -1, okay? And if there were more purchases than sales, then NPR would be between 0 and 1. So let's go over this. These are profits, average returns 6 months after the trade. So we take each trade and we calculate return 6 months after the trade. Some trades may be in June, some may be in July, some may be in August. So we calculate 6 months after each trade and average them. 12 months after trade. So before Dodd-Frank, after Dodd-Frank, they look kind of similar. 25%, 12 months, 25.5, 18.2. So it looks that they were quite profitable after the act also as before. So we take it to the next step. So we subtract market return from each of those trade returns, because when the market goes up, most stocks will go up. So obviously insider trades will also be profitable, right? So after subtracting market return, we call this market adjusted return. Notice what happens. Market adjusted return 12 months after the trade before Dodd-Frank was 18.2. That means if the market return was 12%, then the average insider purchase return was 30%, okay? 12 plus 18. So you would have to add the market return to these. After the Dodd-Frank, big drop, right? However, this is interesting, but this is not really any proof of anything, because these could be all legal contrarian trading profits. So here what we do is we adjust for contrarian trading. We run some multivariate regressions, and I'm going to be very brief with this. So we adjust for contrarian trading. We adjust for company size, book value to market value of equity, and past 12-month market adjusted return. Okay, past, P for past. So past return. So we adjust for contrarian trading profits using these variables from the literature. NPR is an indicative. NPR is the variable that measures insider trading. We use a dummy for the post-Dodd-Frank period. So the interesting numbers here, interesting results here are for NPR, B4, beta 4, and beta 6. So beta 4, NPR's coefficient, these would be average market adjusted returns before Dodd-Frank, and beta 6 would be the change after Dodd-Frank. Okay, so let's take a focus on these two. By the way, the size, BM, MRTP, those shows, these signs are consistent within the literature. This shows insiders were more interested in buying small stocks. They have more information advantage in small stocks. value stocks, and that's what the literature shows, stocks that went down in the past year. Okay, that minus sign shows that. So insiders are contrarian traders. So these are consistent with the literature. But notice what happens. So average return before the Dodd-Frank Act was 6.5% above the market return. So if the market return was 12, this would be 18.5. After the Dodd-Frank, that return drops by 5.8%. So 6.5 minus 5.8 is 0.7. So before Dodd-Frank, the average, and these are average, some could be more than 100% over the market return. So these are averages, right? So 6.5% significantly above market return. And before Dodd-Frank, it's 0.7% above the market return, not above the market return after Dodd-Frank. So significant reduction in insider trading profits after Dodd-Frank. Okay, so here, part of another table, here we look at, use another dummy, we look at extreme insider trading. If 95% or more, NPR greater than or equal to 0.9, that means 95% or more of the trades in a given month were insider purchases, 95% or more when insider sales. So D1, D2, two dummies for extreme trading. So here's what we find. So before Dodd-Frank, if 95% or more were insider purchases, those returned 8.7% over all other insider trades. All other trading profits would be in the intercept. Okay. After adjusting for contrarian trading, it's still 8.7% more profitable when there is extreme buying above all other insider trades, trading profits. But after Dodd-Frank, what happens? 0.3% above the profits from other insider trades. So significant drop before versus after. The sales are not interesting because these are, you can see the positive sign of the coefficients. That means, the stock prices kept going up after they sold. That does not mean the sales were unprofitable. The sales, I did not show you all the tables. The sales were contrarian, so they sold after big price increases. So the sales were probably very profitable, but the prices kept going up. So the sales are not interesting. Purchases, look what happens. 8.7% profits, incremental profits over profits from other trades before Dodd-Frank, 0.3% incremental return, which is insignificant economically and statistically. Okay, so what's the point? The point is that, I'm surprised I was able to get through this. The point is that, at least temporarily, after they passed the law, and extensive media coverage of the law, and the SEC stepped up enforcement by the SEC and regulatory authorities and media coverage of those, insider trading profits, at least for now, seem to have dampened. This is pre-Dodd-Frank 95 to 2010, and we look at different sub-periods within this long time period, and we find this very similar results. Post-Dodd-Frank, August 2010 to December 2018. So in this period, significant drop in insider trading profits. So this paper actually adds to the literature. There's literature with a small number of papers that have looked at other laws, and they all consistently found that insider trading profits and insider trading, strategic trading by insiders was, reduced, attenuated, reduced after passing the law. And that's exactly what we find. So after the Dodd-Frank, no one else has looked at the Dodd-Frank. So, so this is the first paper in this area, but this is what we find. The laws have consequences, at least for a while. Maybe, as I said, 10 years from now, things will be forgotten. Okay, so let's open this up for questions. If there are questions, I'll try to answer them. Are there any questions?
Can I request someone to please mute your mic? So that was a very, very interesting session, Dr. Professor Gangopadhyay, and very, very revealing as well, because we do not know the cascading effects of insider trading that has in our lives, and it impacts the entire economy of a particular country, cascading down to every single individual unaware. That was very revealing. Incidentally, while you were talking, I remember I think we watched a film in 2015-16 which was called The Wolf of Wall Street.
Oh, yeah.
And so we could see a lot of insider trading in that film and how it impacted different lives, and it was a very interesting movie. So I was remembering that, but thank you very much for these very revealing sessions, which consisted and contained a lot of facts and figures that was more interesting.
Can I add something? There's a question here.
Please.
Okay, so I did not, I thought that I would not have time to cover all of this, so I did not address why insider trading is bad for society. And I thought you would talk about that, but insider trading is bad for society because it erodes public confidence in the secondary markets, and the secondary markets exist so companies can issue, raise capital by issuing shares, in the primary market. Okay, so if there is no secondary market, there will be no primary market. People think, okay, all these people are making money by trading shares. What good does that do to society? Well, without a secondary market, there would not be a primary market. And there are other consequences. The cost of capital of companies would be extremely high. Okay, it would cost them a lot of money to raise capital. But, and there are other in the literature, but I think that's probably enough for now. There are some questions that I should answer.
Yes, can we have some questions? If you have some questions, kindly you can write on the chat box and I can read this out for sir. We'll just wait for about 2-3 minutes to have some questions.
I see 5 chat questions or comments.
So I do not find any questions here.
Okay.
But there are comments like it's a very informative and insightful sessions.
Okay, great.
Meghna is writing. There are quite a few other people I think were attempting to write. Let's wait for a while.
Sure.
Meanwhile, I would, may I request, if possible, our very, very senior advisor to the entire group, Mr. Saurav Ghosh, to come in for some time and chip in with his comments and views on this very, very innovative session by sir.
Okay.
Any questions meanwhile coming in? If Mr. Saurav Ghosh sir is comfortable and if he's there, may I request him to chip in for about some time?
He's on mute.
Okay. If ma'am is there, our Secretary General, very honorable Secretary General, Mrs. Bratati Bhattacharya, if she's around.
I would just like to say good morning to Dr. Gangopadhyay, and thanks for
evening to you.
Accepting our invitation. Sorry, I'm outside and I'm wearing a mask. So anyway, thank you very much.
You're welcome.
Are there some questions, Mr. Mitra? Then I think you should take it up and ask him.
Yeah, absolutely. Yes, so I'm just waiting for some questions, ma'am, to come in. I think we have about 37 to 40 students, so I'm just expecting and waiting for some questions to come in. We have already written on the chat box and we still are inviting questions. Sir is here to very gladly answer those questions. Even if the questions come from some of our professors, because they're equally qualified, knowledgeable. And if you want to have a discussion, may I request our principal, dear Dr. Dawn, to come in for a while. And if we can have a small little conversation with our beloved Professor Gangopadhyay.
Good morning, sir. Good morning, Dr.
Good morning.
Gangopadhyay.
Good morning to you.
Good morning.
Good evening to you, I guess.
That's why I'm telling you, in the US it is good morning. It is good morning, and in the it is at present it is 6:30. Now it is 7:30 p.m. So my only question that it is the insider trading. Is there any difference between the Indian stock market and US stock market? Any difference between this insider trading, the operations? I am talking in respect to the operations.
Yeah, I was afraid this question would be asked. Basically, my research has concentrated on the US, and the reason for that is I have the US data, and the data is quite expensive. So I do not have any insights or expertise on the Indian market because I don't have the data. If any of you have the data on Indian insider trading, from the SEBI or whoever, I would be interested in collaborating because we can do a lot of work. However, without the data, I really cannot say anything because I don't have any particular insights. And I've been investing in the US, so I've been following the US markets very closely. So I'm not really qualified to talk about insider trading in India. I know it's banned, And I suspect it goes on all over the world. Okay. So if it goes on in the US, with all kinds of securities and safeguards in place, it probably goes on all over the world. So I would be very surprised if a lot of that is not happening in India, but you will probably be more knowledgeable about the cases that have gone to courts there, than me. So I'm not really qualified to talk about India. Initially, I thought that I would make this a presentation of my paper, but that would be too academic for this audience. This is not really an academic conference. So I thought, maybe I would try to make it a little bit more interesting by giving actual examples, from my experience in this book. And I've seen very suspicious trades. So that's the direction I took this to, instead of making it really academic. The last part was a little bit academic. So I hope that did not throw people off.
But it's very, very interesting session, sir.
Okay,
And
thank you
to
very
conclude,
much.
may I request Mr.
much.
Saurav Ghosh, sir, to come in for a while and just have a small little interaction with you and with all of us. He's here. We're very glad to have him on the show.
It was indeed a very fascinating session, the way you updated us on insider trading in US share market. Now, in India also, we know insider trading is banned. Even in our organizations, we have to sign a lot of papers and other things to ensure that we cannot or do not give out any insider information to any of our near ones. Now, I have a small query. How is the Harshad Mehta case in India different to insider trading? Any idea or?
What was he accused of? I mean, I remember the name and I remember vaguely the case. What was he accused of? Insider trading?
It was not insider trading.
Okay.
He did a lot of other ways of hiking up the prices.
Okay. Manipulation.
Manipulation. It was a scam actually.
Okay.
So after that, of course, the government got very knowledgeable about this insider trading.
Yeah.
And they became very strict in the last 10 years.
Yeah. So I cannot comment on the Harshad Mehta case. Yes. I sort of remember it, but that was a while ago, wasn't it?
Yes, it was quite, it was in late 90s.
Late 90s, yeah. So I don't remember the details, to tell you the truth. So I'm not doing a good job of answering the questions here.
No, that's okay.
But
even Indian SEBI has become very strict on share market shares and insider trading.
However, I still think that a lot of it probably goes on. In the US, what used to happen was earlier in like 70s, 80s, insiders were trading before corporate events like mergers, earnings announcements, and those are too easy to catch. So now, I mean, they've gone underground, so they have become much more sophisticated and it's much, much, much harder to catch. And in my opinion, it goes on, it's pretty rampant, no matter what academics say, and that's commonly believed in the financial markets. The traders believe in, there are dozens and dozens of examples in this book, for instance, and people are making a living for following these trades. They're trading, and these are not the only people who are doing that. They're trading, and they come on TV and they talk about unusual trades, but I followed those, and by the time you hear, it's too late to trade on it. So, I mean, people are making a living from following these trades. So it's rampant, I think.
Yes, in the commercial channels, people are doing a lot of speculations, and many of the people, I'm definite that they have this insider information.
Plus, in the US, India may have a similar thing, but in the US, they have this dark pool market, and that accounts for 30–40% of trading on the New York Stock Exchange. And it's anonymous, it's electronic trading, and no one knows who's buying, who's selling. And probably a lot of laws are being violated there. The government has not looked into these yet. They're understaffed, undermanned, and they are underfunded. And my view is the traders are far more sophisticated than the regulators, in my opinion. I mean, I've not read that anywhere, but that's what my personal observation. I could be wrong, but maybe not. In India, maybe the same is the case. I'm not sure.
It is
Sorry,
definitely.
I don't know. I don't have data for India.
But we
so
must really thank you
Yeah.
for talking on this subject, which is little known to many.
Absolutely. Excellent. Very insightful, sir. And we thank you very, very much.
One question
Okay.
that in the near future, the technology is coming. That is the data science and artificial intelligence.
Yeah.
So, so in that area, the stock market, that is the speculation and prediction. So how it will help the stock market, the artificial intelligence and the data science, particularly the artificial intelligence, how it will speculate that give the or predict the correct prediction in the stock market. Any idea from your side?
Predicting the stock market. Well, good luck with that.
That everything is coming. That in the stock market is very volatile.
Yeah.
To reduce the volatility, how the artificial intelligence will help the stock market?
Okay, so this is not an insider trading question, but
no.
Here's my
general
view.
question. This is your general view.
Yeah, I think that stocks are risky investments. That means we will never be able to predict those accurately. Okay, that's my view. And economists have tried. There are many financial models, asset pricing models. They do a miserable job of predicting, especially with individual stocks. They are widely used, by the way, to calculate cost of capital of companies, for instance. However, artificial intelligence will depend on pattern recognition.
Right.
And the stock market probably does not follow any pattern. There are some broad patterns which have already been recognized by the technical traders, like head and shoulder, like all these, the Japanese candlesticks,
Right.
So those type of patterns have been recognized and they're well known. But those are very general patterns and they are right until they're wrong. And so those are widely used. Those are already known. But beyond that, predicting individual stocks or overall market, I think that's beyond the capability of technology. Because think about what that means. If you can predict the stock return, then stocks will become like treasury bills. If there's no risk, then the return will be like the risk-free security, right? So the stock market will cease to exist. If you can predict stock returns, treasury bills in the US pay, the treasury bonds, 10-year, I follow the 10-year, it's about 1.3%. The 10-year treasury note, that's 10-year US government borrowing on 10 years, that's supposed to be risk-free, 1.3%. If you can predict stock returns, then stocks will become like that, and it will pay 1% return a year, which is below the inflation rate, by the way, in the US. So I don't think we will ever be able to predict those, no matter how technologically sophisticated the world becomes. And you don't want to be able to predict it, because if you can predict it using a model, then all the fun will be gone. Why do people invest in stocks? Because they expect to earn a higher rate of return. And in the US, the banks will pay you 1% interest. So if you're saving for long-term like retirement or children's college education, you have no choice but to invest in the stock market. You have to, because in India, I used to see in the 90s, banks would pay 7, 8, 9% interest to my parents, for instance. I mean, those days are gone in India also. Interest rates are lower. But in the US, it's 1%, and you lose money by keeping money in the bank because you pay tax on that and inflation rate is higher than that. So that's why people invest in the stock market. And if stock market becomes like a bank account, it'll pay 1% interest. I don't think that will ever happen. And you don't want that to happen, in my opinion. Right. So good luck predicting stocks. If you can figure it out, please let me know. We can have a partnership. I'm willing to. Go ahead. Sorry, didn't want to dilute this. Sorry.
Any more questions, please?
Yes, there is one question, interesting question.
Okay.
From Mr. Utsav Chakravarti.
Okay.
He's asking, is there insider trading in cryptocurrency?
Insider trading in cryptocurrency. Okay, so that's beyond my area of expertise. Cryptocurrency insider trading. I know they have some ETFs, insider trading. I've not heard anything, but that doesn't mean, I don't know.
Okay, so we'll keep that question for you to perhaps come back to us at any time.
It is a very little known subject.
Yes, it's a very niche subject. So perhaps
it's very new and very niche.
New and
yeah.
We don't know what happens in that.
Any more questions, if I may ask the audience to ask?
For cryptocurrencies, you might have greater insight if you can predict what China will do next.
Yes.
You know, they're banning cryptocurrencies, right? And so they have laws against cryptocurrencies in China now, very recent news. And so if you can predict that, you can probably predict the direction of cryptocurrency prices. But good luck with that.
Great. So as we come to the conclusion of this entire session, extremely insightful. I thank you very much, sir, for giving us so much of insight in this very niche, as our Saurav Ghosh sir told. Very, very niche and very, very informative as well. I think everybody has got benefited, and we welcome you to Calcutta Business School whenever you are in India and whenever you're in Kolkata. You said the other day also when I spoke to you on the phone, you said you have quite a lot of friends and family in Kolkata. So next time when you visit there, we will be in touch and we will welcome you to our campus.
Thank you for the opportunity. This was a lot of fun. I do have a quick question. Is Dr. Shekhar Chaudhary, is he still with the Calcutta Business School? He was the IIM Kolkata director.
No, he left us about 2 years ago.
Oh, okay. He was my professor at IIM Ahmedabad.
Yes, he was the director there also.
But
sorry, he was in Kolkata. IIM Kolkata, he was the director.
He was my professor at IIM Ahmedabad. I met him in 2009 in Reno. But anyways.
Yeah, he was associated with us.
Yeah, yeah, it was fun. And thank you very much for
Thank you very much to everyone.
Opportunity.
Thank you very much, everyone. And thanks for joining.
Okay. All right. Bye.
Bye-bye. Take care of yourself, sir.
You.
Stay safe. Thank you.
You too.